Be strong.
So this is going to be the 2021 tax season. 2021 went so fast. It blew by. I didn't believe it was Christmas when it came. It happened so quickly. Now we're in January and we have one more week left of January. Can you believe that? So it's moving really, really quickly and tax season is upon us. Due to the fact this is going to be recorded and we are going to publicize it on YouTube, we have to put a disclaimer for people who are not our clients, letting them know this is informational. Any questions that you may have if you're not a client of Taxko, speak to your tax advisor so they can advise you on your specific needs. Well, like I said before, there's so much stuff. There's so much information to go over in this meeting that what we did is we try to just encapsulate it into the things that we feel that you should know, which are the high priorities. A wise man knows that he knows nothing or everything, because only a fool knows everything. So we're not going to make the assumption that we know every single thing that's going on, but we are going to touch on the top lines, because there were almost more than 3 or 4 different tax bills that passed. If the Building Back Better bill passed, we would have made almost 4 bills that we would have had to read through and go over. So once again, we're going to go over information. So the tax season starts on January 24th, 2022. That's what the IRS says. We know as tax professionals, we've been in the game for very long. That's not true. They're going to be doing a lot of retooling, checking their systems, making sure that things work in a perfect manner, because they have a lot of things to worry about. So the probability of you submitting your documentation and us getting the tax return out next week is low. It's very, very low, due to the fact that everything that's going to happen is going to be retooling. We kind of project maybe around like February, you should be able to file those tax returns. Not saying don't send in your information. If you get your W-2s and all the information, definitely send them in. We can get the return processed, but the ability to file it, more than likely, the IRS are going to fix all their bugs by the 1st and 2nd week of February. And if you're coming into this meeting, please mute yourself if we don't do it already, so everyone can hear the meeting. So, like I said before, there's going to be some government delays. We know there's going to be government delays, but we want to make sure that you guys are organized. The delays are going to be a couple of things. It's going to be earning credit, child tax credit, American Opportunity credits. And those were the delays prior, but there's going to be more delays onto it. And that's what we're going to jump into right away. So there's going to be 3 big issues that we're going to have to worry about for the 2021 tax season that we're going to file in 2022. One of the first things is the advanced child tax credit. Now this advanced, I think you have to mute me because I think I gave you feedback. This child tax credit, you have to, someone has to mute. Because the moderator, please mute. All right. So this child tax credit is in advance. And if you got money from the advanced child tax credit in error, you would have to repay it. There is a safe harbor, which we'll go over on one of the slides. But unfortunately, if you receive money and things change and it's not in your favor, there will be you will have to repay that money, but we'll go definitely into that. So as you know, what happens if you have a child under the age of 6, you get $3,600 per child. The government advanced you 50% of that over a 6-month period in 2021. And if you have a child between the age of 6 and 17, there was a $3,000 credit, which was also advanced to you. This credit is actually fully refundable. So what that means is if you had unemployment, you weren't working at all in 2021, you still can qualify for this credit. In prior years, how the tax law worked, you had to have some form of earned income of $3,000 or more. That law has been erased. There is no earned income floor. So you could do nothing, honestly. And if you have a child and that child is your qualifying child, you would be able to qualify for this credit. So I think that's a very good thing to know. So we know that there's going to be people filing that received unemployment and didn't receive any income that still will be able to get this credit. So the safe harbor. So what does that mean? The safe harbor means that the IRS used either your 2019 or your 2020 tax return to figure out this credit. But if you did not have the ability to claim that child on your 2021 return, because remember, this is in advance. 2021 tax return is filed in 2022, the year hasn't ended. So if you come to file your return and we realize that you're not claiming a child that you claimed last year, you may have to repay some of this credit. But the government stepped in and say, hey, listen, we'll give you a safe harbor. And that safe harbor basically ends at certain income limits. So as you can see, if you're married and your income's under $60,000, you have a safe harbor. If you're head of household and your income is under $50,000, you also have a safe harbor. And if you're single and you have a child and you're not claiming head of household because you don't keep up the household, your safe harbor is $40,000. They'll give you a $2,000 exemption. So if the government advanced you $1,800 and you don't have that child on your return, you don't have to pay back that advance because you have that $2,000 safe harbor. So that's going to help a lot of people if they weren't really thinking about it, especially people who have separation agreements, who got divorced in 2021, who have an odd or even agreement. This is going to be very important because some people were getting the money and didn't really even know it. It was coming almost every month, but you couldn't even know. Honestly, my wife had to tell me that we received the money. I didn't even know it was coming in the bank account, and I'm an accountant. So I know this is going to be an issue for a lot of people that may not realize they received the money and did not go on to the IRS portal to turn it off. Because when you turn it off, both the husband and the spouse have to turn it off. So how to avoid this issue? What we really ask you to do is bring in the IRS form 6419. You should have received this form. That's what the government says. You should have received this form in late December or early January. If you haven't received it, it's not the end of the world. Hopefully you'll receive it before the tax season starts in the office around February. But we do need that form. That 6419 form basically lets us know how much money you received in advance. If you did not get that form, there's an IRS portal. You can go to the portal and you'll be able to see how much you received in that portal. When we have it on our personal expense worksheet, when we get to that slide, we'll definitely go over how the personal expense worksheet has been updated to make sure that you are fully prepared for this tax season. And worst case scenario, you may have to do some checkbook accounting. What that basically means is you would go into your bank account or your checking account and see around the 15th of every month, starting in July, if you received a deposit from the federal government. And if you did, you add those numbers up and you provide that to us. I mean, that's a worst case scenario. It would be in our best interest to get some verification. And the reason why is we learned from last year, if you do not get it right, it's going to delay your return. In addition to that, the IRS may give you a refund in error and then ask for it back. Or worst case scenario, they don't give you the refund and you think you have a refund and you actually owe. And you get a letter saying, well, you thought you had a refund of $1,000, but you actually owe us $500. So we definitely need to know that information. So the second big issue, so I say, is the recovery rebate. And that's basically the stimulus of the $1,400 that Biden gave. This is not going to be as confusing as it was when we got the stimulus through the Trump administration, because it was broken into two parts, $1,200 and $600. And honestly, 2020 was a blur. A lot of people didn't really remember, did I get $1,200? Did I get the $600? In addition to that, the $600 either fell in December or in January of 2021. So either December of 2020 or January of 2021. So it made it really hard. This year, it may be a little bit easier because it's $1,400. And this one, unlike the advanced child tax credit, if you get money in error, you do not have to repay. So that's great. The money was in advance, like I said before, $1,400 for your dependent. If things change, what that means is just like the advanced child tax credit, they use your 2019 and their 2020 tax return to figure out that credit. So if your income was high on those years and you didn't get the whole 1,400, you only got 1,000, when we file the return, you can get that additional $400. We have a client out in Texas that welcomed a new child into their family in December. That person not only gets the additional child tax credit of the 3,600, they would also receive the 1,400 because that child was not born in 2020 or 2019, so no one knew about it. So those are things that we have to definitely think about. But once again, the biggest thing is the form. We need a form. So the IRS, just like the advanced child tax credit, is going to give a form called a 6475. And that form would let you know about how much stimulus money you should have received or received in the year. There is, once again, there's an IRS portal that you can go on to, and that IRS portal would be able to let you know how much you received. Of course, you'd have to set up an account and verify yourself. And last but not least, you can do some checkbook accounting. And our personal expense worksheet, once again, we're trying to make this as easy for you as humanly possible. That's our goal, as easy as humanly possible. So when we talk about the personal expense worksheet, you'll see that we have links embedded on that PDF that you can just click and be able to go straight to the website to check out the information. So the next big thing that changed is the child and dependent care credit. Now, people sometimes get it confused that the child and dependent care credit and the child tax credit, they're two separate credits. The child tax credit is for having a child. The child and dependent care credit is to have a child, and you're also sending that child to child care in 2021. So the credit expanded. It used to be $3,000 per child. It went all the way up to $8,000 per child. The credit is now 50% rather than 35%. And the reduction rate is even lower. So in the past, the reduction rate was about like $43,000. Now it's $125,000. So this is really going to change. Now, some people took the benefit of taking it through their employer, which is not a problem. Your employer should have increased the amount of pre-tax from that $5,000 to $10,500. So if they haven't, definitely speak to your employer. And the good news is it carries over. So in the past, if you didn't use it, you lose it, you get penalized on it, but you have the ability to carry it over moving forward. So there's three rules that we have to understand about the child and dependent care credit that we're going to go over. And these three rules are some must rules. And the reason why is because the numbers went up. So this is going to be a high fraud area, and the IRS loves low-hanging fruit. They love it. So we're going to make sure that you're doing the right thing. So we're going to go over the three things that you need to know. And honestly, some of the rules suck. I'm not even going to lie to you. Some of the rules just suck. But once I explain to you the logic that Congress has, you understand why they did it this way. So the first rule is the age of the child. And so the age of the child has to be under the age of 13 in 2021. With tax law, as of December 31st of that year, so the year we're talking about is 2021, whatever that child age is the age we can use for this credit. So if your child was 13 in November, their birthday was December 7th, they turned 14, unfortunately, we can't get that credit. And I know it sounds really, really bad, but it's just how it works. We've been through at least 4 or 5 audits on this, and it's so hard to win that we barely don't, to be honest with you. So we know this is going to be an issue. So if your child turned 14 in the year and you did have childcare expenses, unfortunately, we can't take that. If the child is over the age of 13, they must be unable to take care of themselves or disabled to take this new expanded credit. Now, this other rule is you and your spouse have to be employed or in school. So what that means is the IRS basically is saying, hey, if you are married and your husband or your wife is working and the husband's at home and just trying to make things work, and he's not at school and he's not working, and you send your child to childcare, the government is saying, well, we're not going to give you the credit. We're only going to give you the credit if you and your spouse are either working or in school. And the thought process is, this is allowing you to do more work. And I know I'm a parent. I have 2 kids. It's hard to do work when those kids are around. So I could really feel for a person where the spouse is home and just trying to take care of things, and they just send the child away, and you're paying money just so you can get things done. But unfortunately, if you are married and you and your spouse, well, both of you are not working, or both of you are not in school, we cannot take this expanded credit. Residency. So in addition to the child being 13 and you and your spouse working or going to school, you have to prove that you have some form of taking care of residency. So what that means is, if you are a single mother or a single father and you're living with your parents, you have a child and you're working and you're going to school, but you send that child to childcare, but you can't prove that you pay 50% or more of the living expenses of the home, we can't take this credit. And the thought process is, if you're not upkeeping the home, that cost is more important. So it sounds weird, but just what it is. So some of these tax strategies that we are doing is, if you do have a person that you're living with and you don't upkeep the home, you're not paying rent, you're not paying 50% or more of the expenses, and both of you, the people, are doing taxes with us, it's easier that we can put that child on that person's return just for this credit. They don't get the earned income credit, they don't get the child tax credit, they don't get any other credits. It's just for this credit. That IRS allows us to do that. We put a Q code in there, and they can just get this child care credit. So at least the household doesn't lose out on that money. So that's one of the tax strategies that we've been looking at. So how it works. So this is how it was prior. So prior, the max deduction per child was $3,000. Now it's $8,000. The max number of kids stayed the same. It's 2. It's just 2. So if you have 3 kids and you're going to childcare, it's just what it is. Got to kick the can. It's what it is. The maximum deduction that we could have took prior was $6,000. Now it's $16,000. So you can see it expanded, because in the past, people would come into our office and say, I paid $11,000 and change for childcare. And I'm like, you can only take $3,000 of it. And it hurt their heart. It hurt their heart, because when you pay for daycare, it's a lot of money. Sometimes it's the same amount as rent. So it hurts your heart when you can't take all of it. So with this expansion, this helps out a great deal. So prior, how it used to work is, your income had to be from 0 to 43 to get a higher percentage. So most people, when we did the return, would have got the 20%, $1,200. That's just the norm that everyone would see. Now what's happening is, if your income is under $125,000 and you have 2 kids that are going, you're paying that max $8,000, you get a credit of $8,000. That's a large amount of money. That can wipe out your whole tax liability and give you a sizable refund. And as you can see, the credit doesn't really change that much when you go up in income. Is when you get to around $400,000 is when you don't see that much of a benefit, but it's still there. So this is a very big credit, especially for parents that are paying for childcare. This is going to change the game for you, because this will help lower your tax liability when we do the return. And once again, we're going to need some paperwork showing how much you paid to the childcare provider, their tax ID number, and their address. So in the past, there were some people that would send the child to a family friend and they pay money and really didn't bring it in, because they're like, I don't really care about that credit. But now I think you're going to really care about that credit. So, just knock on the door, let the people know that you need that information, and let's just really get it done. The next big thing that's going on is charity giving for 2021 tax season, the child deduction for non-itemizers. So that means people that are not itemizing on their return, they're taking the government standard deduction. We can take up to $600 if you don't itemize, or $300 if you are a single person. And this is going to help out, because when the Trump administration came and changed a lot of the laws, a lot of people fell into the standard deduction and they were giving charitable contributions and they weren't seeing the benefit of it. Imagine coming into the office and you're giving me your property taxes, your mortgage interest, your charity, and you don't see it on the return. And you're like, Mr. Fraser, call Carlisle, you'll call me, you'll call Gail, you'll call Angela, you call Joan, and say, there's a mistake because I gave you everything. And it's not a mistake. It's just that the standard deduction is so high, you don't really see it on the return. It doesn't make a difference. So by them allowing us to take this additional charitable contribution, it really helps because charities really needed help in the 2021 and 2020. They were definitely helping a lot of people, especially food pantries. So the standard deduction for 2021 is $12,500 for single individuals, $25,100 for married, and $18,800 for head of household. So it's really hard to get over that. So what we did is we gave you a quick example. So let's say you're head of household, you have a child, and you make $85,000. Your child got hurt, you put braces on their teeth, $5,000. Medical expenses are limited to 7.5% of your income. So you're not going to get a deduction. You have an amount, but no deduction. You pay state of New Jersey taxes on your wages. You also pay property taxes of $10,000. Even though you have $13,500 in deductions, in an amount, we could only take a deduction of $10,000 because of the prior Trump tax law. Even though Trump is still not in the office, the tax laws still live on. And if you had charity of $850 in pure cash, you were tithing to the church or you gave to organization and you donated some clothes that had a value of $200, we have this deduction of $1,050. So your itemized deduction is $15,050, but the standard is $18,800. Of course, we're going to take the higher number. And that's how it works. But now we get to get an additional $300 if you're head of household or single. And if you were married, this $300 would have been $600. So if you do have charitable contributions, definitely let us know about it so we can take this additional deduction because it's given to us. It's a given. It's a layup. Let's take this layup. All right. So unemployment compensation. So in the past, last year, in the middle of tax season, when Biden came into office, they did a retroactive change. If you received unemployment, they gave you an exclusion. There's not going to be an exclusion this year. So if you received unemployment, you weren't taking taxes out, assuming that this exclusion is going to help you, it is not. In addition to that, we have a client that was going through issues with unemployment. They were holding her money and they paying her all lump sum in 2021. It's actually 2020's unemployment, but they're paying it to her in 2021. And, luckily she called us and we had to break it to her. Like, there's going to be a tax liability. We did a quick projection to see what it is. And she was able to make some, estimated payments into it. But if you received unemployment in 2021 and you weren't doing withholdings, it is going to be 100% taxable. Each state is different. In New Jersey, it's non-taxable. In New York, it is taxable. So depending on what state you are, there are going to be other taxable issues. But that's the biggest thing about unemployment that you're going to have to worry about. So with all that being said, we're not going to really expecting bigger refunds because you had the advance of the child tax payment, student loan interest was paused, and there was some mutual fund distribution. So the probability of high refunds is there for some taxpayers, but we're not going to see a large amount of refunds across the board. And that last one, the mutual fund distribution, that's going to be the one that's going to really scare people. We have a client that's in Japan, that's still a U.S. citizen, and we finished her return, and she was like, what? Where's this $14,000 of capital gains coming from? And we indicated your mutual fund made a distribution. She said, I didn't do that. They don't have to do it that way. They can make a distribution and they can basically reinvest it. So if you Google stock gains in 2021, you'll realize that stocks were going bonkers in 2021. The gains were double digits, 26% in the S&P 500, 18% in the Dow Jones, and the NASDAQ had 21%. Legally, these mutual funds are required by law to make regular capital gain distributions to their shareholders. So what that means is if you have money inside of these mutual funds, they're playing and making your money grow. So you're seeing your investment grow, but you get taxed on that money every year, regardless of you receiving that money, because it's being reinvested. So we're going to see a lot of people coming with 1099s from their brokerage house, and they're going to be kind of surprised because they didn't physically touch the cash because this money has been reinvested. So that's going to be an issue. So the refunds, they're going to be there, but we know that it's going to be slightly lower than the prior years. Customer service is key. On December 13th, 2021, Biden signed a rule. Basically what he said, he slapped the IRS on the hand. He told the IRS, you guys dropped the ball completely and don't do it again. Because think about it, if any business says, yeah, we were affected by COVID last year, you understood. But if they kept on saying we're affected by COVID, it sounds a little bit strange. So Biden basically indicate, return phone calls. So if you call the IRS has the ability to basically send you a call back, and that call back can come to you. There's new online tools and services that you can do, and they are doing things. One thing that we put in the red is that they're expanding automatic direct deposit refunds based on the prior year returns. So what that means is if you don't let us know you want the money to go into a different bank account, it will go into the bank account that it was prior automatically. That's just how it's going to go. So definitely let us know about your update in your bank account so we can know on that annual client data sheet. So what if you don't get a refund? It happens. It's not the end of the world. Some people may not get a refund, and we totally understand that. And it's not the end of the world. As our clients, we give you different options. We let you know about payment plans that are available to you. We let you know about different strategies that we can do. And we think about the next year. We're always in the future. Right now, we're thinking about 2023, even though we're doing the 2021 tax return, because we're always trying to think forward. And the biggest issue that we know is going to be is your W-4. Your W-4 is a big game changer. And the reason why is when the Trump administration came in, they changed the W-4. And the reason they did it, they want to give you more money in your paycheck. That more money in the paycheck indicated the economy is doing well. If the economy is doing well, the administration looked good. So this W-4, we're telling our clients, we're always telling our clients, just fill out the top part, your name, your last name, your address, and either pick single, married, and we really don't like head of household, just married or single. And the reason why anything below this is a payday refund. They would advance you the credit. So if it's child tax credit, they'll advance you the child tax credit. If you think you're going to get a deduction from your business for a loss, they'll advance you that money. So it's really dangerous to fill out any other part of the W-4. And that's what we usually see when clients come in, they owe their W-4, they put down 1 or they put down 2 in the box for children. Because there's no 0 or 1 anymore. It's either you pick this and you indicate the amount of children that you have on a term or the dependents or additional expenses that you expect in the future. All right, so we're trying to make things as easy as possible. So we have some forms, which is our annual client data form. So this is the annual client data form, same thing as last year. We definitely asked you to fill it out, and we highlighted things that we definitely want you to pay attention to. Did your bank information change? Let us know. How do you want your documentation in the portal, paper, or mail? Let us know. Definitely put the date on it so we know when the information comes in. As you can see, the form is very interactive. We're trying to help you as much as possible. And then we have the personal expense worksheet that we want you to fill out. So you let us know your medical expenses, charitable contributions. And right here, did you have at least 300 of unmarried or 600 of cash contributions? Let us know so we can take that deduction for you. Let us know about your child care if you had child care. It's all on this form. This form helps us a great deal because internally inside the office, when we do our 3-stage review, we look at these forms. It helps us out. And on the form, we have the information about the stimulus and an advanced child tax credit. So we have 3 links here. These links will take you to the portal to let you know about the amount of money that you received in stimulus, the amount of money you received in an advanced child tax credit. So if you click this, it'll take you straight to that portal without you have to do any huffing and puffing. So once again, use these forms. It's going to be on our website. We're going to put it on the website later on today. So by tomorrow, you'll see it. We'll send out an email to let you know these forms are available to you. But these forms are really a true ingredient for us because it helps us out a great deal, especially the annual client data form. If you're removing something, we look at the address here. If you don't let us know, because there's so much information coming in those 3 months, we can't, we don't know everything. So we need to have you fill out these forms. We beg of you, we beg you, sir, to fill out these forms because we need it ASAP. So we talked about the forms. So fill out those forms. It helps us out a great deal. And it leads us to the preparer penalty. So what's going on is, if we get something wrong, there's going to be a penalty to us of about $500. So you may feel that we're probing you. You may feel that we're asking a lot of questions. And the only reason is because we have to do our due diligence. We have to make sure, did the child live with you? Let me get a copy of something showing the child lived with you. You'll say, oh, man, I gave it to you last year. Unfortunately, I need to know that the child lived with you this year. This is the 2021 tax return, not the 2020 tax return. We need to know if you went to school. Send us a 1098-T. Oh, man, I went to school. Don't worry about it. No, we are worrying about it because we have that penalty that's with us. So when we ask you a lot of those questions, is because we have a due diligence requirement. It's not us really being a pain in your butt. It's just really us just trying to get as much information as possible. So if the IRS knocks on your door, we have everything already. And I know there's clients where the IRS sent them a letter and we had it. We were able to shoot it out to them and they felt really calm. So if you could give it to us now, it helps for you to get it. We're basically your file cabinet at the end of the day. One of the big things is a lot of people work from home. I'm home right now. So home office, unfortunately, if you are not self-employed, is non-deductible. It's sad. In the Building Back Better bill, they want to add a couple of those things back onto the tax return. Once again, the Building Back Better bill didn't get signed in 2021 as it's supposed to. It was held up. But if Biden does sign it, these are one of the things they want to add back. But all these things right now are basically not deductible, but may come back in the Building Back Better bill. We kept them on the slides because we thought the Building Back Better bill would have been signed, but it hasn't been signed as of yet. So education, if you went to a school and they cancel your debt, Biden signed a bill to allow that to not be taxable. So we're not going to see 1099-Cs from a lot of schools. It's not going to be a taxable event. So that's really good news. If you went to a school that was either defunct or they canceled your debt, that's going to be something that's big. So other individual changes. So everybody, you felt it when Ida came through. Ida came through like boom. It was a surprise, Essex County, Union County. It was just a crazy thing. So there's a tax deduction for casualty loss for federal disaster areas. And we are able to take that on the 2021 return because we were in a presidential disaster area in the state of New Jersey and New York. If you took money from insurance or FEMA, it has to reduce that deduction. But these are things that are going to be deductible. So how it really works is, in the past, if you had a casualty or loss, you could have took it. But when Trump came into office, he changed the rules saying that it has to be a U.S. president declared disaster. For example, I had a rental property in Newark and it caught fire. And I couldn't take that deduction for any expenses over the insurance because the Newark, New Jersey wasn't in a U.S. president disaster. So now that we do have a U.S. president disaster, we are allowed to take that deduction. And it has a 4-step process. Basically, We need to know the cost of the damages. And this cost of damages is after insurance or after FEMA. So anything that you had to pay out of pocket that wasn't covered, we reduce it by $100. And then we have to take 10% of your income and reduce it even again. So in this example, if your basement got flooded and you had to do 20,000, FEMA covered 10,000, you cover the other 10,000 and your insurance really didn't come to it because you didn't want to bother them for some strange reason, you can get an $8,300 deduction. Depending what type of property it is or where it is, it goes on a different line. So if it's personal property, if your main home, it will go on to Schedule A, which is really not as cost effective as it would be. If it's a rental property, it goes on to Schedule E, which will give you a great bang for your buck. And if it's a business property, it will go on to Schedule C or through itemized. So that's a big deal. So in the example we showed you, this is how it would work. So how it would look, just like how we showed you the other time, if a person had it, it would come on the itemized deduction. So that's why we said if it's your personal home, we may not see a bang for your buck because once again, if the government's going to give you a standard deduction of $18,800, doesn't really matter what your itemized is, we're not going to see it on the return. So this is really for rental property owners, business owners. Now, if you do itemize and you do have a loss, still bring it in. We're just letting you know that don't think you're bringing in 5,000 and you're getting 5,000 out the door. We're going to make sure we look at everything and see what you qualify for. And that goes into the big thing, business. So the business tax law update. So a business is a lot of things going on. So the 20% deduction to QBI, what that basically means, if you have a business, there's a 20% deduction on top of whatever you have deduction for the business. So this is for, in-home businesses, Uber drivers, Lyft drivers, home-based businesses, single-member LLCs, partnerships, and S-corps. So we definitely look at that QBI. There was another big issue, the employee retention credit. This is more of a payroll thing. The reason we're telling you this is because the government changed the rules in November 15th of 2021. If you took that employee retention credit on your payroll, the government changed the rules. This is not an issue that you would come to us with. This is a payroll issue. So we just want to let people know if you do have that issue, it's not for us. That's more for your payroll provider. So now a big change, now, even though this is not going to be for your 2021 tax return, the 1099K change. And what that means is the $600 change. That thing is going to throw a wallop. And the thing is, the government already knew about all this. The IRS already has all the information. In the past, we got 1099Ks for like 1,000, for almost like 700 before. It's just that now they're mandating that you have to look through that $600. This is very, very new. I know when we had the our staff training yesterday, a lot of us were concerned about what if you send money to a friend or you Zelle and you do all this? We don't know how it's all moving through, but what we do know is if you have a business and you are Zelling people, you are doing Cash App, you are doing PayPal, you're doing any of that, the threshold has now fallen to $600. We're going to keep you updated on this because it's going to be a lot of information. But one thing that we would definitely say if you are a business is bookkeeping. Either do bookkeeping in-house, you buy QuickBooks, or you do other things. Our goal is by at least February 1st, we can give people a free worksheet that they can use. And the reason why, when the 1099K came out, and I think it was around 2008, we were in DC, me and my father were at the DC conference at the IRS. What they basically said is that these merchant companies don't have to tell us about the fee. So what that means is, let's say you Zelled someone some money and for business, and you Zelled them 600, but the person only got 500. The person who received the money, they're thinking they only have 500 to pay taxes on. No, you have to pay taxes on the gross amount, even the amount that's being taken out. So you have the ability to take a deduction for those expenses, but if you don't know what it is, how you can take a deduction for it? So record keeping is going to be the big thing for this. A lot of people say, well, how do you get around it? The way you get around it is bookkeeping. tracking your expenses. That's how you get around it. This law is here to stay. It's here to fight identity theft, people stealing money. It's here to fight money laundering. It's here to fight that. So the only way around it is to keep accurate records. I know a lot of people are worried about if you're doing the SUSU, box hand, and all that. Keep records, and then what we will do is we will put it on the return, and we'll back out the amount that you paid out. But it's a paper trail. It's a paper trail now, so we have to be worried about that. If you have more questions, you could definitely talk to us about it. But the basic gist of it is keep accurate records. All right, so last but not least, there is a tax credit for self-employed individuals of a maximum of $5,111 if you were vaccinated in 2021. So how it works is if you were vaccinated between April 1st, 2021 and September 30th, 2021, and you were self-employed, you are able to qualify for this credit. Self-employed, or if you were unable to work because of the vaccination, or you were recovering from an injury, disability, or illness or condition of the vaccination, you get the deduction. So take, for example, I took the Moderna, and the Moderna gave me the chills, bro. Like I was all messed up. For one day, I really couldn't work because I had a pounding headache. And it was really, really hard for me. So those days I can take this credit. The credit is up to a total of 10 days, which is equivalent to 80 hours. And it goes on your self-employed income and is capped at $511 per day for 10 days. We're going to use the form 7202 for this for taxpayer and spouse. So if you are an Uber driver, you work from a home-based business and you have income, if you're a partnership, you can take this credit, but you have to pay into self-employment tax. So what that means is if you have a partnership, you have a client that have a partnership, and they invest in stocks, they don't pay into self-employment tax because all they do is invest in stocks. They can't get this credit. You have to pay into self-employment tax. If you are a C Corp or an S Corp, you can't take this credit because you were supposed to do it inside your wages in 2021. This is a fully refundable credit. So what that means is if you have a tax liability of $1,000 and your credit's $1,700, you can get a $700 credit refunded to you in your refund. So if you are working a 9 to 5 and you also have an LLC, you can still take this credit. However, if your box 14 of your W-2 shows the $511 because you took the sick pay with your employer, you can't double dip. You can't get a double benefit. So it would only be a one-time thing. Either you took it with your employer and you got the sick pay and it's on your W-2 in box 14, it'll show us, or if even it's not, we then can take it on your LLC. But if you are a 9 to 5 worker and you do a side hustle, we can't double dip on it. We have the ability to elect to use your 2020 income. So if your income was higher in 2020 than 2021, we can use your 2020 income to elect for this credit. You're not required to go to a doctor to claim this credit, but record keeping is key. We're not going to ask you for your COVID vaccine card. We're just not going to do it. I feel like this is all a HIPAA lawsuit waiting to happen. What we're doing is going to ask you, did you receive the COVID vaccine in the time frames that we indicated, and did you have symptoms? That's all it was. It's a self-certification. And to be honest with you, I was injured in December and I went to the hospital. And I was wondering why they didn't ask me about my COVID shot, but I looked at my chart, it's right there. They saw both of my shots and my booster. So they know everything. So this is not a place where I would try to do any trickery. Like I said before, S Corps and C Corps do not qualify. However, they do qualify for payroll. So if you are S Corp or C Corp and you're paying payroll and you did have that vaccine, you can go back and ask your payroll provider to do an amendment. Is for the form 7200. As long as you have less than 500 employees, you offered yourself some sick pay, and you took leave from the vaccine, you'll be able to get a credit. So what that means is if you paid yourself inside your S Corp or C Corp between those days for days you weren't working because you were sick on a sick pay, the government will refund you back up to $511 per day, up to 10 days. That's the equivalent that they would do if you're S Corp or C Corp. So you can still get it, but it has to be through payroll. But if you're self-employed, we can do it on a return now. So this is how it basically looks. The way you get the maximum credit, you have to have $150,000 to get the maximum credit, but every dollar counts. So if you have a profit of $500, that $20 will count. You'll take the $20. I bet you'll take that $20. If you have a $5,000 profit, let's say you were doing Uber, there's a $180 credit, or $10,000, there's a $360 credit, $50,000, $1,780. So basically, it's basically a 3% credit that you get on top of it, and it's totally refundable. So if you did receive a COVID vaccine and it was between those time frames and you felt sick and you weren't able to work or telework, you can definitely get that credit. Changes in the mileage rate in 2022. So once again, like I said before, we're always thinking in the future. We're always thinking about what's going on now. So in 2022, I would definitely start keeping records for the mileage rate, because the mileage rate went up to 58.5 cents. It sounds like little change, but it adds up, I'm telling you. And a lot of people, especially business owners, come in with their gas receipts and their repairs, and we're like, miles are way better than that. Miles give you more bang for your buck. But one thing I would say is, if you, let's say you bought a new Tesla and you want to write it off, we can't take mileage. We can only take the actual expenses because you elected to write off your vehicle. So we'll go into that. So here's a quick example. Let's say you had car insurance of $200, repairs of $50, and to fill up your car is $50 a week for 4 weeks. And you use your car 80% for business. If you use your actual, we can get a deduction of $360 per month. But if we use mileage, we can get a deduction of $468 per month. That's a savings of about $108. So as you can see, mileage breaks out better. So if you are an Uber driver, if you are a real estate agent, if you are a salesperson that drives around, definitely keep track of your mileage, because it's going to definitely help you for 2022. This is not 2021. We're just talking about some future stuff. So planning tips, just think about planning. Think about us when you want to do an entity choice or doing charitable giving. If you want to do a gift, stock options. Our goal is to try to help you as much as possible through you. We're open all year round. We're always there. I think me and my father sleep there sometimes, because we're there so much. So, definitely give us a call. Complexity, we'll look at your tax structure. We'll definitely give you as much planning as humanly possible. There are certain things that we're doing. So what we're trying to do is expand the Taxko metaverse. So we're going to be doing ebooks on a website called WOMA is our website. We're going to be doing LLC formation just for New Jersey. That's just going to be the niche. It's just New Jersey. It's going to have the same but higher quality of LegalZoom or Zen Business. Business funding, we have partnered with a lending company because we see everything already. So it makes sense that we help you with all this instead of you going out to a third party. FCLS Consulting would help with funding, and we wrote a book for rental property owners. So when we send out the email, we'll send you all these links. A lot of these things are going to start in the next couple of months. I know we have some questions that we want to go into, but once again, I definitely like to thank you guys for listening. There's a lot of information. Once again, this is recorded. We're going to put it out, and we're going to put out the slides. Thank you so much for listening, and we can jump into questions.
Carlos, before we get into questions, I just want to go over a few things that I want to, just bring to the attention of our clients. And the first one is the direct deposit. If you normally receive a check, try to change to direct deposit, because the checks, the mail system and clients receiving the checks is not as before. Even today, I got a call from a client whose return was filed. The IRS sent the check since in September, and today they haven't received anything. So I think we should opt for the direct deposit option as much as possible with reference to your refund. And the second thing is the W-4. As you said, just fill out the top And another reason why only the top is you should fill out, because that form is giving the employer too much information. Too much information you're giving the employer. Your second job, the income of your spouse. You don't want the employer to know those things. There's a fix for it. If you come, you see us, we'll work out that fix. The annual data, I know a lot of people used to say, oh, it's same as last year, we ain't got nothing, no changes, no nothing, da 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 da. Please fill it out. Because you might not remember, but these things, tickle your mind or tickle your brains, and you're able to, come up and remember something. And the other thing, and the most important thing about that annual data, it helps to alleviate the CP 2000 audit. Because a lot of clients, you may forget something, you didn't remember something, unemployment, all of these things you might not remember. And if we don't have it, it did not go into return, and then a year later, the IRS is sending you a CP 2000 audit letter saying that, you didn't report this, and you owe more taxes, and then we have to come back and we have to rework the return in order to fix it. So, and the other thing is the last thing I want to ask is the feedback in reference to the time. Last year, we did this conference during the day, and this year we decided to do it in the evening. I don't know which is better. So must give us some feedback on that. And let's go to some questions I see here. Somebody said this is a perfect time. Evening, I see somebody saying evening. Carlos, you want to answer? I think we had a question there before. Okay.
All right, I'm
Carlos,
going through it.
It seems like I'm getting a lot of evening is better.
For crypto, Eugene Waiters, for cryptocurrency investment, there are different platforms, high interest earning leads based on the daily payout isn't tracked through the report. Oh, so basically, Eugene Waiters, one of our clients that knows cryptocurrency very well, was basically indicating there are certain platforms where cryptocurrency isn't tracked that much. If you go through it, you could definitely look at that. When we answer the question about the 9 to 5 and LLC for that credit, we talked about the 1099K rules. We talked about the mobile payments through Vimeo and Zelle. I think that was about it. If there's any other additional questions, you could write it in. If not, we have about 5 more minutes. Nighttime's a killer. Daniel, man, comedian.
Well, I think it's because somebody said the echo and the feedback. I think it's because my mic and your mic is on. I may have to disable my speaker when I'm talking so that it doesn't have the feedback. But when I'm talking, I gotta disable my speaker or Carlos mute his mic. So last time we were in the same room, and it was fine, but this time Carlos is at home, I'm at work. So
I'm at work too. I want to point that out.
There's a tool. Can you recommend a tool for tracking mileage? Carlos, what's that tool? There's a
called Mileage IQ. I think I wrote it wrong, but it's Mileage IQ. If you have QuickBooks, QuickBooks also tracks your mileage for you also. So
an extension, will we get penalized? Okay.
Answer that question. So
if you file an extension,
it doesn't stop penalties and interest. It does stop the largest penalty, which is the late filing penalty, but an extension, the interest and penalties still accrue. But like I said, I'll talk more offline to that client about that. It was a good question though. Hayes and Beasley. Yeah, so regarding the payments, taxes, Brazil payments, the Cash App, how do we go about remitting taxes before they are? So it's the same thing. What you would do is we would do estimated payments. You would figure out what but everything boils down to bookkeeping. Everything goes back to bookkeeping. If your bookkeeping is not up to date, we don't know what's going on. So you have to keep accurate books and records. And I would say anywhere from 25% of your net income. So if your income is 5,000, your expenses is 4, the net income is 1,000, 25% of that you should set aside for federal taxes and 5% for state of New Jersey. That's a good rule of thumb. Yeah, yes. Bring the chat in here so we can see.
Well, Ms. Beasley was saying the taxes is on your net and is not on your gross. So, as was Carlos was saying, you look at the bottom line. And if you're going to make a loss, then all this we're talking about here is mute. Because if there's a loss, there's no self-employment tax, there's no income tax.
How granular is the IRS looking at our bank? So IRS already knows about most of our bank transactions already. It's already there. Because remember, I believe it's the Fourth Amendment covers only things in your house. You don't own the bank. You don't own your cell phone records. You don't own your metadata. So the IRS has the ability to look at things without you. So unfortunately, the IRS already knows. But if you're not doing anything wrong, there's really nothing to worry about, honestly. But there's a good question. But yeah, the IRS does know about inflows and outflows if they want to. If you're not high up there, they're not really looking at every single human being. They don't have the data capacity to do all that. In the future, yeah, when my son's 5 years old, when he's 40 or 41, cash may be useless and it's easy for them to data mine. But as of right now, I don't think they have the ability to look at every single ones, but if they want to, they can.
Which QuickBooks app you recommend if you're going to do the software, which is on a laptop or your desktop? The QuickBooks Pro is good. The online QuickBooks, Carlos, if you want to talk about that, the online QuickBooks.
Yeah, the online QuickBooks is really good. I mean, especially if you're technology savvy, it connects to your bank account. It does all the flows and we can jump into it and look into it. So they have different levels. They have levels as low as $7 or $6 for self-employed, and they have levels all the way up to $35 a month. So if you just go into there, you could definitely check out what's available. But there's if you type in QuickBooks pricings, there's different pricings that are there, and it fits your need. All right, so it's 8 o'clock on the dot. We'd like to thank everybody. If you have additional questions, you can definitely email us and call us. I know there's some people on here. I still have work to do for you. I'm getting to it. So once again, we thank you so much, really, for listening, because all we're trying to do is give so you can be great clients also. Have a great night, and we'll see you in a couple of months.
Okay, thank you also. Thank you, everybody. I see some names, old clients, new clients. I want to thank you for, logging in and coming into this webinar. And we'll do it every year. We'll try to do it twice a year because we need to help our clients build wealth. And in order to help you build wealth, we got to encourage you to have businesses, encourage to structure your business, encourage you to have mutual funds, stocks, bonds, mutual funds, all those good things. Because taxes is one, but the overall picture is to create wealth for you and your family. And again, thank you again, and we'll see you during the tax season.
Bye, guys.
Be strong.